Investors distributors are requested to note that the objective of this meeting was to communicate with our distributors and to share with them our thought process. It should be noted that views expressed in the recorded call were based on the information available in the public domain. Views expressed in the call can change depending upon changing circumstances. Nothing discussed in the call shall constitute a buy, sell, or hold recommendation. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Hi, good evening, everyone, and welcome to today's conference call organized by PPFS Mutual Fund. Thank you for taking the time to join us today. Today, we will discuss two of our flagship funds, the Parag Parekh Flexi Cap Fund and the Parag Parekh ELSS Tax Saver Fund. We are delighted to have Mr. Rajiv Thakkar, the Chief Investment Officer of PPFS Mutual Fund, and our fund management team, Mr. Raunak Onkar, Mr. Raj Mehta, Mr. Rukun Tarachandani, and Ms. Mansi Karya joins us on the call. They will share valuable insight on how these funds are managed, the investment philosophy behind them, and their approach to navigating the current market landscape. We have received quite a few questions from you well in advance and clubbed the common questions. Now, without further ado, I would like to hand over the call to Mr. Rajiv Thakkar to start the discussion. Rajiv sir, over to you. Thank you.
Thank you, Shailendra. Thank you, everyone, for taking the time out and joining us for this distributor conference call. A lot of you may be with us for a very long time. However, some of you may have come on board recently. So I'll just briefly share the approach that we have in our fund management approach to equity investing or the other asset classes as well. So largely the approach is that we will have very limited number of offerings where we are really convinced that we can offer a differentiated product for the distributors, for the end customers. And we run it with our skin in the game. So even before the SEBI regulations came in, a substantial portion of our personal investments, of the company investments, are in the schemes that we run. And rather than coming out with frequent scheme launches and then asking you or the end client to shift from one scheme to the other, we have schemes which we would want them to do well across the up and down cycles. People who have been with us at least for the last 12 to 18 months would have noticed that we have been a bit cautious on the markets given the high valuations that were there some time back and which still continue in some pockets. So given that we have been staying with sectors and shares where valuations are reasonable, where the prospects are attractive, and we have not been forcing ourselves to deploy money in companies or sectors where we think things do not make sense. So what this does is, in a very rapidly rising market where some of the newer listings or some of the loss-making companies are in a big upswing, we tend to lag the market at such times. And when things correct, as is happening in the last few months, we tend to do better than the markets. Our aim is not to do better than the index or better than the category averages or any specific fund on a month-to-month, quarter-to-quarter basis, or even on a year-to-year basis. What we aim to do is we aim to deliver decent returns across a cycle. And by a cycle, we mean at least a period of 5 years plus. A lot of people have been concerned about what happens now, where are we in terms of the market valuations and the outlook in the future. And the headlines always will have something or the other which will concern us. So yesterday's headlines, for example, would talk about the tariff war and the imposition of tariff on Canada, Mexico, China, all these countries and things like that. So if you look at it over a period of 3 to 5 years, all these things even out. Today we don't sit back and try to think of what were the headlines a year back or 2 years back. In fact, we are in 2025. If you were to go back 5 years, 2020, right now we would probably be worried about the rising COVID cases in China, and we would be worrying about upcoming lockdowns. Now, after 5 years, those things do not matter so much. So, I would urge distributors and clients to stick with the asset allocation plan, which is determined by the end client's needs. If you have a young client, mid 20s, early 30s, late 30s, has 20, 30 years to retirement, is focused on building retirement corpus, creating wealth, then surely money should go to equities. Over the longer term, I definitely would expect equities to do better than the fixed income options. But if you have a senior citizen who depends on monthly cash flows, monthly income, then obviously most of the investments have to be in high quality debt instruments and some investments in equities to protect against inflation and to protect wealth in the longer run. So it would largely be driven by your client needs rather than the market outlook. Market outlook is more or less the same as what we have been talking about. Indices have fallen 10, 15%, 20%. Individual stocks have corrected more. So definitely some excesses are being corrected. However, there are still pockets of overvaluation. There are still pockets where opportunities are there. We are deploying money wherever we are finding opportunities. In other areas, we are waiting for our prices to come. So that stance continues. Our cash holding as on the last fact sheet date would still be there. So we would be roughly around 22% in money market and debt instruments for FlexiCap. And in ELSS tax saver, it would be in the region of 18-19%. So more or less, that's where we are. We'll take more of the outlook questions as we go along. So we can start with the Q&A.
Hello everyone. We will begin with the curated set of questions submitted through the form circulated with the registration. Following that, we'll take the live questions. You can submit your live questions in the chat window. First, we'll start with the curated questions. So first question is to Rajiv regarding the AUM size. What constraints does AUM size impose on fund management, and how might this constraint affect performance? Up to what AUM can you adhere to your value investing principles? Can top quartile performance be maintained regardless of the AUM size?
So this question has been there for a while, and obviously we are growing in size. So if we look at only equity AUM, you would be among, I would guess, the top 15 asset managers in the country on a equity AUM basis. At the same time, we have to keep the AUM in, you have to keep the context in mind when we look at the overall market. So today we have a situation where a company with a market cap of as high as 30,000 crores would get classified as a mid cap. So while PPFS has grown in terms of assets, the overall number of companies that are listed in the market have also increased. The overall equity market cap in India itself has increased. The other thing which we have been highlighting earlier as well, and I'll reiterate that today, is that since we manage largely two equity schemes, the FlexiCap and ELSS tax saver, the AUM looks optically larger for us, whereas in the case of other fund houses, it would be spread over, let's say, 10, 15 equity schemes, and it would be fragmented, although the same team would be managing those assets. Again, as per regulation, there are limits on how much a particular fund house can own of a particular company. So that limit is at 10%. So if a company has 100 shares in the outstanding, then any fund house cannot own more than 10 shares. Now, this is irrespective of number of schemes. So if you run 10 schemes, then each scheme on an average can own only one share. So it doesn't help fragmenting the assets into multiple schemes. It just increases the complexity. So this is the part where I'm saying one should not take the AUM too seriously. At the same time, I realize that very small companies will not move the needle for the schemes that we run for FlexiCap. So today, to expect us to buy uh, a significant stake in a, let's say, a 2,000 crore market cap company, and that one investment will suddenly change the return profile of our FlexiCap fund, that will not happen. Uh, Also, what you will see is in the small cap space, we will have slightly larger number of stocks as compared to what we were owning earlier. And this is a feature of the small cap space. The individual company risks are also higher, and the in order to maintain liquidity, in order to adequately diversify, people buy a larger number of stocks. If you look at the small cap funds run by other fund houses, you will find 100, 150, 200 companies in those portfolios. While we don't anticipate having that higher number, you will see a small increase in the number of companies that we have in our portfolio, given the larger size. Yeah,
Thanks,
as
Rajiv.
far as the question on following the value investing framework, our framework will remain the same irrespective of the asset size. We will not buy something we are not convinced about. So, management quality is important for us, business quality is important for us. Uh, we prefer low leverage, and we will buy only when we are convinced by the valuation. That framework does not change. There was a question, will we maintain top quartile performance? Answer is no. We don't aim to be top quartile all the time. We aim to deliver decent returns across an investment cycle, as I said in the opening remarks, over a 5-year plus period. Again, it's a market linked product. There are no guarantees about the future, whether we will beat the index, whether we'll beat the category average, or which quartile we will be there. So there are no guarantees as far as the future performance goes.
A continuation on this question. When small and mid caps become attractive, will FlexiCap fund and the tax saver fund diverge in their India allocation given the size constraint on FlexiCap? If an investor seeks mid and small cap exposure, would it be better to invest in a tax saver fund than the FlexiCap fund?
We run the tax saver fund and the FlexiCap fund very similarly. If we like a company, we would aim to buy in both the schemes. There is a small difference in stocks between tax saver and the FlexiCap. There are largely two reasons for this. Tax saver cannot do cash flow futures arbitrage, and tax saver is mandated to be minimum 80% invested at all times. So because of that, we invest in slightly in some more companies in the tax saver. The other difference is that FlexiCap can invest to some extent in overseas stocks. These are legacy investments. Incrementally, we are not able to deploy much, but legacy investments are in foreign stocks, which tax saver is not permitted to do that. Because of this, there will be a small difference in tax saver and FlexiCap. But other than that, we run both these schemes in a similar manner. If we find small caps being attractive, we will try to buy them in both the schemes. As I mentioned, the number of stocks may be higher, but in today's environment, for example, when small cap stocks are falling far more than the larger cap names, today, if we choose to buy small caps, we have enough liquidity. I don't think liquidity is a problem. It's been always a question of finding the right company at the right valuation. We are not trying to buy stocks in a particular market cap going forward. We are trying to buy attractive companies. Those attractive companies could come in any market cap, and we will be happy to buy those.
Thanks, Rajiv. We'll move on to the cash call. Curious to learn more about how you managed to anticipate the recent market downturn. Specifically, I would like to know how you were able to make the decision to increase the cash allocation rather than staying fully invested. Additionally, I would like to inquire what is your strategy going forward? How long do you plan to maintain this cash position? At what point would you consider deploying this cash back into the market? What are the factors that will guide this decision?
So I am not a very big fan of this phrase, which is called cash call. Largely, when we have money in our bank account, our objective is to deploy that money in equity assets. When we deploy money in equity assets, we have to create a diversified portfolio. It is not that if I like one stock, I can put 100% of my corpus in that one stock. We need diversification across company groups. We need diversification across sectors. There are target portfolio weights that we would have in mind depending on the nature of business and things like that. So if I want a 1.5% allocation in a pharma company, just because I have cash doesn't mean I'll take that allocation to 5%. That target weight will remain intact independent of how much cash I have in the portfolio. So at our AGM last year in December, I had drawn this analogy. Let us say you are going from Mumbai to Pune and you are passing the ghats in Khandala and Lonavala. Now, on a straight road, on the expressway, you may drive at 70-80 kilometers an hour. But on ghats, you will want to slow down. You will want to take the turns. And if there is some place where there is pedestrian crossing, or if there are speed breakers or potholes, then you would want to go very, very slowly. It's not that you will maintain the same speed throughout your journey. Similarly, when you are investing, when valuations are very attractive, you would want to be fully invested. But when valuations are at higher levels, you would want to slow down. You would want to take your time, wait for the right opportunity, get fully convinced, and only then invest. So in the question you asked, how did we predict that markets will come down? We did not predict. Let me be very clear on that. In fact, in 24, our CEO Neil Parekh and I both independently in two different interviews, we mentioned that we are slowing down. We are sitting on some amount of cash. And if markets continue to go up indiscriminately, then we will be happy to underperform in such a market. So there was no prediction saying that on this date or in this month, market will start coming down. What we were doing is, if we were not finding opportunities, we were not forcing ourselves to deploy. That's all there is to it. Today, when markets are down, again, we are not waiting for a particular market bottom level. Tomorrow or on Monday, if we get one company which we like at the valuation that we like, we will go out and deploy in that company. So deployment will also not be indiscriminate across the board. It will be on a company by company basis. So largely, we are not dependent on any macro events, any election outcomes, any monetary policy guidance or interest rate increase, cut, or anything like that. It's purely driven by our analysis of the company's value and whether it's attractive enough to buy or not.
Thanks, Rajiv. Next question is for Ronak regarding the foreign stocks. Can PPFA's FlexiCap resume investment in international funds? Are you implementing USD INR hedge to mitigate sudden forex currency movements in the FlexiCap fund? And how will rupee depreciation impact your foreign investments?
Okay. So for the first question on deployment in foreign stocks, so like Rajiv mentioned earlier, these are all legacy positions that we have. And since February 2022, we have not been able to remit new money abroad for buying overseas stocks as part of the RBI restriction of $7 billion for the entire AMC industry. So from that angle, whatever dividends that we get in our existing holdings, those we have been redeploying, and we are free to reallocate our foreign stocks among the money that is invested overseas. So if we feel we have to sell one stock and buy something else, we are free to do that, but we're not allowed to send new money overseas. So no new investments will happen there, but we can shuffle that portfolio if we want to. Second question was on hedging. So again, hedging, we have seen over a period of time, the volumes in the cash, the futures exchange for currency hedging have come down dramatically. Again, because of regulatory intervention. So we have not been hedging our portfolio also. And on that regard, if there is rupee depreciation or currency movement, it will impact proportionately to the USD value of the portfolio, which at the moment is about 12.5%.
Yeah, rupee depreciation increases the rupee NAV, and rupee appreciation will reduce the NAV, just for context. But again, the currency movements are not that severe. It typically tends to move in 1 to 3% kind of bands. It's not as significant as equity price movements.
Continuing with the foreign stocks, are there any concerns about overvaluations in the US markets, particularly the 4 NASDAQ stocks that are in our portfolio?
So clearly, some companies are not reasonably priced, but they are fairly priced. I don't think there is overvaluation in many of them, these companies, because the underlying businesses are still performing and growing. Some of these companies are also multi-business kind of companies. They are holding companies of various businesses in a way. So if you look at a company like Amazon, it will have retail operations, cloud computing, advertising, third-party sellers, logistics business, all under one roof. You see company like Microsoft, which will have software business, cloud services under one roof. You will have company like Google or Alphabet, which will have digital advertising via their search product, YouTube product, which is the bulk of their revenue. And they also have cloud services, and a company like Meta, which is purely a ad platform model. So some of these trends are still in favor of these companies in terms of cloud computing adoption, or even digital advertising, which is shifting from traditional advertising to digital or online advertising. So these trends are still in favor of these companies. So as long as the overall trends are in favor and they are a large market share of these markets, so the growth has been intact in these companies. But valuations, agree, they swing a lot. At the moment, they are not very, very cheap, but they are not expensive as well, that we have to sell and run away.
Next question is to Rajiv on the ELSS scheme. How do you perceive the relevance of ELSS under the new tax regime starting next year? Will ELSS continue to exist independently, or will it be merged with FlexiCap fund, or will the lock-in period be eliminated? Additionally, will declining inflows impact the performance of ELSS scheme?
Sure. So this is a completely new question that we have got. All along, the question that we get asked is, will so much of inflow affect your performance? This is a complete opposite question. Will declining inflows affect your performance? I don't see why lack of inflows should affect performance. That is one. And we have been seeing inflows actually. ELSS has been getting money. So we have been asked this question around ELSS. Let me clarify things so that people are at ease. As of now, the new regime and old regime both coexist. There are still people who are part of the old regime and who want to invest in ELSS to get tax breaks. There are some investors who, even though they don't get tax breaks, they are willing to invest in ELSS just for getting the normal returns without getting the ATC benefit. About the lock-in, ELSS is a statutory kind of scheme where people who invest in ELSS have to be put in the 3-year lock-in. So till the time the old regime exists, and from the date of the last ELSS customer that we get, anyway, we have to keep that locked in for 3 years, that last client locked in for 3 years. Till that time, we cannot merge it with any other scheme. We cannot change the scheme category, nothing. So ELSS will definitely continue in the existing form, at least for next 3 years. And beyond that also, I don't see why it should change. Even if future investors do not get tax breaks, they will still get the equity linked returns that ELSS provides. So people who are investing for equity linked returns should also not have any worry. As in when we announce anything, any change that we do for ELSS will come into effect only 3 years plus after the date of the announcement. Not, we cannot announce today that after 1 month this is going to change in ELSS. No. Minimum period between the announcement date and the effective date will have to be 3 years.
Next question is on tariffs. How do the recent changes in US tariff rates impact Indian manufacturing, services, and other sectors? Additionally, what is the impact of new import policy allowing Tesla, BYD, etc. to enter India at lower duties? Could this pose a competitive threat to Maruti and M&M in our portfolio? Does this affect your investment outlook on them?
So, tariffs are work in progress. So, every day there are new headlines one way or the other. So, in January itself, we had these announcements that tariffs on Mexico and Canada will come into effect. Then, a little while before the tariffs came into effect, there was a pause. Now, again, there is an announcement that they will again come into effect. We don't know how long the tariffs will last. Will there be an impact on US inflation, on US consumers? If yes, will they be rolled back? Again, the impact will differ from company to company, sector to sector. How much of the company's exports are to US, that will be a guiding factor. Are there US competitors who can switch if the tariffs come into effect? In a lot of cases, the answer there will be no. So I don't see too much impact. And again, when I said invest in equity with a 5-year plus kind of horizon, I can virtually guarantee that 3 years from now, 4 years from now, the headlines will not be talking about tariffs. They'll be talking about something else. So all of these are transitionary things. I don't think the promoters of the company decide to start a business or exit a business based on newspaper headlines around tariffs. I wouldn't place too much importance on that. The EVs and the reduction in import duty on EVs is an interesting question. Will the entry of Tesla affect Maruti and Mahindra? I think the answer would be clearly no, because Tesla is in the higher end cars, whereas the sales of Maruti and Mahindra are in far cheaper cars. More important is what happens to companies like BYD and other Chinese companies. Those are manufacturing and selling cars which are probably cars which can affect the sales of Maruti and Mahindra. The policy of the government has been clear. Although we are reducing the import tariff in the initial years, but the roadmap is that the companies should eventually start manufacturing those cars in India and not just keep importing those cars. If that has to happen, I think companies like Mahindra's, Tata's, Maruti, these companies have a established dealer network, servicing network, established brands, and they are working on making the transition, creating relevant EVs for the Indian market. Do we have a very strong view which will hold steady over the next 5 years? Answer is no. Like distributors, like end investors, we will keep re-evaluating this as and when monthly sales data keeps coming out, as and when product launches happen and we see what the consumer preferences are. For now, I don't see immediate or a medium-term impact on the companies that we own.
A question on the market outlook. With current market scenario and everyone wanting to sell small and mid caps, what's your position on the same? And what is your general view of the Indian equity market for the next 12 to 18 months?
So while markets were going up, the valuations in small and mid cap had gone up far ahead of the valuations in the large cap. This is at the broad level. Individual companies may have different numbers. And again, in the correction, when prices are falling, small caps are falling faster than mid cap, and mid cap is falling faster than large caps. When we are evaluating companies to invest in, we are looking at companies across the board. We are looking at larger companies as well as smaller companies. Wherever we find things attractive, we invest in those. Pockets of overvaluation still persist. So 15-20% kind of fall at the index level does not mean that all excesses have gone away. A lot of segments are still severely overvalued. Some pockets have started becoming attractive. So that is where we are focusing our attention on things which are starting to become attractive and which could probably find a place in the portfolio in the coming months. Outlook over 12 to 18 months is very, very difficult to give. That's the reason why we keep insisting invest only if you have a 5-year outlook. If some end client is wanting a 12 to 18-month outlook, I think that person is best served by other products like liquid funds, arbitrage funds, debt hybrid products, or other things. As always, 12 to 18 months is very, very uncertain.
Next question is to Raunak on the research process. Are you adopting LLMs to do equity research? What was your experience so far?
So I would consider myself to be in the experimentation phase right now. When we look at some of these tools, we try and see where they fit into our existing process. So the only useful tool which I found, which has surpassed even my understanding and expectation, was the product called Notebook LM, which is by Google. And the reason why I like it is because it can confine itself to the documents and links that you provide to it, and you can converse with the documents that you are sharing with them. So it sometimes helps you summarize things quickly and also gives you reference links to where the data was picked up from. So there is no contamination of the models going on the internet and finding some random information. But there are these new products which have come up like Deep Research by OpenAI and other companies as well. We keep testing them, and we keep testing them against our knowledge as well, just to see whether the models are capable of giving a human-like insight. So far, they are not there, but I think we are in a good trajectory. These models could not do these things 12 months back, so now they're capable of doing much more. So we'll see how they evolve and how we can integrate them in our research process. But they are useful to the marginal extent right now.
Next question is to Raj on taxation. What is the tax implication for NRIs investing in ELSS tax saver fund? It will be beneficial if you could explain the same for conservative hybrid fund as well.
So NRIs get a benefit for investing in ELSS under ATC. For conservative hybrid fund, there is no benefit as such for NRI. So there is no differential taxation between residents and non-residents. For conservative hybrid fund, it is taxed at your tax slab, irrespective of whether you are a resident or an NRI.
Yeah. Next question is to Raunak on portfolio strategy. There are several sectors where you currently have no exposure, such as chemicals, auto ancillaries, aviation, defense, etc. Are you unable to find good companies within these sectors, or is your research universe limited only to top few companies?
The research universe is quite wide, and we found a lot of good companies over here. But unfortunately, the valuations, if you see 5-year, 10-year median valuations for all these companies, they are still above those valuations. So they are not in the comfortable zone for deploying, but we keep tracking them. So we like several companies in this space. And we should also not forget that these companies tend to be cyclical, despite their specialty chemicals or special contractors for defense or aviation or auto ancillary. They also follow the respective cycles of the sectors. So we have to understand, is it cyclically the right time to invest? Plus, the adjusted valuation is below the median valuations over a long period of time as well, because these things have not met right now. So although we track them, we have a wide enough net to cover these companies, but the valuations is the biggest concern right now.
Question to Rukun on arbitrage fund. In the last con call, you explained about impact of various taxes and charges on arbitrage fund. Can you explain it once again in a more elaborate way?
Yeah, so I think the question refers to the charges that we incur when we are doing arbitrage. So these would include brokerage costs, STT, PCM charges, and other such charges. So whenever we deploy capital or whenever we put in an arbitrage position, there are some charges that get incurred. And similarly, when we unwind an arbitrage, there are some charges that get incurred. So let's say if just on ballpark, if let's say 30 bips is the charge total on putting in the arbitrage and unwinding, and the cash and future spread is 100 bips. So then the net after all these charges that I will make or the fund will make is about 70 bips. So whenever these charges, if the charges increase, then the net spread that the fund can make goes down, and if the charges go down, the spread that the fund can make improves. So I think the question in last con call was around the increase in STT, and to that extent, there is a small decrease in the net spread that the fund can make because of the increase in STT.
Next question is on fund performance to Rajiv. Parag Parek FlexiCap has outperformed other FlexiCap funds in the current market. Is this outperformance primarily due to investments in US markets? If we exclude the overseas holding, how would the fund perform compared to its peers?
So we don't do these calculations often, but it's very, very easy for distributors or investors to figure this out. So as was mentioned, we have a ELSS fund which invests only in Indian stocks, and these stocks are also very, very common. If you look at the 5-year returns of ELSS tax saver fund and 5-year returns of the FlexiCap, there's not much of difference between the two returns. And in the shorter periods, 3 years, 1 year, there would be some small difference here and there. Sometimes one scheme would be doing better, sometimes the other scheme would be doing better. I think the benefit of international diversification is more to do with reduction in the volatility rather than giving you higher returns. Indian markets have done well, US markets have done well, both have done quite well. And across different time frames, you will find one doing better than the other. But main benefit comes in terms of the reduction in up and down. So FlexiCap has been around for, let's say, 11 years now. India-specific events, both positive as well as negative, will have a muted impact on FlexiCap NAV. It will rise slowly and fall also slowly. So it will go in a more stable manner. So positive impacts like a surprise tax cut or a political victory of NDA in 2014, that would have a muted impact on the FlexiCap NAV. Again, a surprise demonetization or a surprise election result in 2024, again will have a muted downside impact on the FlexiCap. So main benefit is lower volatility rather than higher returns because of US markets.
A question from someone having opposite experience. The Parag Parek FlexiCap fund is not performing as strongly as it did previously. What measures are you taking to restore its position to top of the scheme category?
So whoever has asked that question, I would expect, it is my guess that the person is relatively new to the equity markets, and the person should look through the history of stock market cycles and how equity investing is to be done, because otherwise the end clients will also face difficulty. People cannot expect equity to give fixed deposit kind of returns month after month or quarter after quarter. I think if someone is not happy today, that person is unlikely to be happy maybe a few years down the road. So I don't get the question. So in terms of the returns as compared to the benchmarks and category averages, it's doing reasonably well. If the question is on absolute returns for the last 3-6 months, I think the person should only invest in equities or allocate to equities, whatever money is there for the longer term. Equity schemes or flexi-cap schemes are not suitable for short horizons in terms of investing.
A more personal finance kind of question. Parag Parag Flexi Cap Fund has been a strong performer, but how suitable is it for long-term retirement plan for generating a regular lifetime income through SWPs? What would be a safe withdrawal percentage to ensure lifelong income sustainability?
So, how much in debt, how much in equity is linked to the person's individual circumstances, cash flow needs, risk tolerance, and various other factors. Broadly, in the current environment, if we say debt securities are giving somewhere between 7.5% and 8%, and if we say, I was just looking up the 10-year category averages for flexi-cap funds, these would be around 12%. So if we say 8% in something like a debt instrument and 12% in equity and a 50-50 allocation, the nominal returns can be in the region of 10%. Again, this is risky because market keeps going up and down. Let us say you take the blended return as 9% or 8% to be conservative. Let us say you bake in 5-6% kind of inflation, where the nominal return is not the real return. You need to mark it down for inflation. Broadly, something like a 4% kind of consumption from your investment corpus should be more or less okay. This is what theory says, personal finance theory. But again, actually, it is not, as asset managers, it is not our expertise to guide individual investors on their asset allocation or on their withdrawal rate. But I think conservatively, anything in the region of 3 to 4% of the investment corpus should be okay.
A question to Raj. How is the NAV of FlexiCap calculated? What I'm interested in is, let's say today US stocks fall, will the decline reflect in today's NAV or tomorrow's NAV?
So what is supposed to be done in the calculation of NAV is that we have to take live or the today's price of both the markets. So for example, NAV of 28th Feb will have prices of today's Indian market and today's US market, but the NAV will be declared on the next working day by 9 a.m. So that's the deadline to declare the NAV. But NAV would include today's prices of both Indian as well as US market.
So we'll be taking live questions shortly. If you have any live questions, you can click on the Q&A button and submit them. Next question is to Rajiv. How much could portfolio turnover of 80% cost the investor compared to a turnover of 20% if all else is same?
Yeah. So every time someone buys stocks and sells stocks, they have to incur STT, they have to incur brokerage charges, and for institutional managers, which is PMS, AIF, or mutual funds, since they buy and sell slightly larger quantities, there is something called the impact cost. Their own buying will cause the price to rise slightly, or their own selling will cause the prices to fall slightly. If you look at the pure transaction cost, which is brokerage plus STT, each leg would approximately be 0.15% or 15 basis point. So one round of selling plus one round of buying would be 30 basis points or 0.3%. That would be roughly, if the entire portfolio were to be sold and bought again, it would result in 0.3% impact cost one time.
Yeah. Question to Rukun. Your thoughts on SM REITs, I think small and medium REITs. Can FlexiCap or ELSS funds invest in them?
SM REITs is a fairly new asset class, and while they provide higher yields, they can also be relatively more risky because a given SM REIT might own as low as one property. So consequently, there is a higher risk versus, let's say, a REIT which owns properties ideally across multiple geographies. As of today, I think there's only one SM REIT that is listed, so it's a fairly new asset class. As and when we have many more listings, that asset class develops, then we'll take a call and we'll see if it makes sense. Today, it's fairly new.
And ELSS anyway, as per regulation, is not permitted to invest in REITs. So whether SM REIT or otherwise, in ELSS we don't buy any REITs or InvITs.
Yeah. One more personal finance question. What is your recommended strategy for making lump sum investments in FlexiCap and ELSS funds? Considering current and projected market conditions, do you recommend continuing with SIPs instead? What should be the ideal investment horizon to target optimal returns from these schemes?
So whether to do lump sum or whether to do REIT, whether to do SIP, depends on whether you expect the market to be flat to downward or a rising market. In a rising market, it's better to do a lump sum. In a sideways or a downward market, better to spread it out. But no one knows the direction of the market. The reason why a SIP or a STP is recommended is that it takes away the discussion with the end client in terms of timing the purchase of the lump sum. So if you say we are going to do a STP over next 12 months, then the client is okay, saying I'll get the average price of the next 12 months. Then the client does not fuss too much on when will the tariffs come in, what will RBI do with the credit policy, what will the next quarter's earnings be like, and any other timing question goes out of the equation. But finally, equity market has to do well and the fund has to do well for the client to make money. So for that, it is recommended that only longer term money is put into equities. Behaviorally, it's easier to convince the client to do a STP rather than convince the client to do a big lump sum at one go.
Do you look at technical charts when investing?
So technicals do not play a major role in our buying and selling, and we do not do okay, here there's a resistance, there's a support, or now there is a view over there. Broadly, the past chart will give the overall range of the company, or is it a cyclical stock or is it a non-cyclical. Again, that price movement has to be seen in conjunction with the earnings trajectory and things like that. So it is not that you will never find a chart on our screens ever, but that does not play a role in terms of determining the buy or sell decisions that we make.
Given that US markets are overvalued, are you planning to move the money from US to markets like China and Brazil where there is valuation comfort?
So first of all, US markets are not that overvalued. There are some pockets where valuations are stretched, but it doesn't mean the entire market is uninvestable. And when you look at these other emerging markets like China or Brazil, we tend to forget that these markets don't have a very long history of capital markets. And the laws and regulations are also evolving compared to what they are in developed markets like North America or developed Western Europe or even developed Asia. So we prefer to invest in these international markets where the law is in favor of minority investors and has a good history of that law being implemented and enforced. So I think some of the markets, even though there might be deep value or cheaper stocks available, we tend to stay away because the risk profile also goes up. And also the laws can change in some of the emerging markets based on the governments that get elected. So it's very tough to predict how the business and the legal environment for investing will be. So far we'll stick to only developed markets like North America, Western Europe, and developed Asia.
Also, although the companies that we have invested in are listed in the US, they have sales and profits all over the world, the companies that we have invested in. So Amazon operates in multiple countries, Microsoft operates in multiple countries, Google operates in multiple countries, Meta operates in multiple countries. So the business risk is not concentrated on only North America. Essentially, you are participating in a global business when you invest in those companies.
As of now, PPFA's flexi cap is dominated by large caps. Now, small caps are fairly valued, and hopefully, mid caps valuation will likely come down. Do you plan to increase small and mid caps in the next 3 to 6 months?
We look at each company on its own merits. So, for example, in 2020, in the crash, we bought a lot of capital market related companies. Now, at that time, the thinking was not whether this is a small cap, mid cap, or large cap. We just saw that the opportunity was attractive. It just so happened that they were in the small and mid cap space. So, we bought stockbrokers, asset managers, exchanges, depositories around that time. We sold those companies in 24, or we reduced the weightages in 24. Again, not because they were small cap or mid cap companies, but because individually those companies were looking expensive and the cycle was looking to be turning. So the future purchases will also be driven by the same considerations. It may so happen that small cap and mid cap stocks become attractive and we end up buying those. But decision will largely be company by company.
We'll move to a few stock specific questions. First to Ronak, what were the reasons for selling Ipca Laboratories? Given that pharma basket continues to be less than 5%, why not increase exposure to this sector? Also, exiting Sun Pharma from portfolio in 2023, is it considered a mistake?
So the pharma basket, if you look at the origin of how the basket was created, was based on companies who got hit by FDA warnings or import alerts, and because of which the stock price corrected disproportionately. And that was a good entry point because the other ingredients were present in the business, which is a diversified portfolio, a reasonable balance sheet, the ability to again go back into these markets after the issues are resolved. That was the entry point for some of these companies. For specifically companies like Sun Pharma and Ipca, although the other ingredients remain the same and the businesses perform okay over a period of time, the valuations were quite stretched in both of these companies, and that's the reason we had to exit them. And that will continue to happen. That's the point of the basket, that if a company no longer is relevant from that point of view in terms of valuation, where other things remain the same, then the companies can change. And we have seen that in the past where we sold Lupin and bought Cipla. So these kind of changes will continue to happen, and we keep evaluating different pharma companies from that point of view, which will fit in the basket approach that we have for that sector.
What are the reasons for selling ICRA, even though it is a monopoly business?
So it's a oligopolistic business, not monopoly. So they compete with CRISIL, CARE, and other rating agencies. The growth has been anemic. So despite the promise, the growth has not been there, and valuation has gone up. So purely on that reason. So having limited competition is a good factor to invest in. Doesn't mean we'll never sell it. So we have sold or we have reduced our stake in things like MCX or CDSL. Even those are duopoly or monopoly businesses. So it's not that we'll never sell those companies.
One more question on stock specific. Despite PPFA's fund managers stating that Power Grid and Coal India are not long-term compounders, why have we had it since 2021 and 2022 respectively?
I don't think we have said that for Power Grid. We have said that for Coal India or for coal specifically, that someday far in the future, once renewable energy and storage uh, has taken deep roots, maybe we'll not require coal for generating power. So that's far in the future, but possibly that scenario could become for could play out for something like a Coal India. Power Grid, irrespective of the mechanism of generating electricity, whether it's wind, whether it's nuclear, whether it's thermal power, hydro, you will require the grid to evacuate the power and transmit it to the end consumer. So these are companies which are trading at attractive valuations, and we continue to own them. So there's no specific reason for not owning them. Again, this question, if you think about it long enough, various companies could have risks 10, 15, 20 years out. So the question could be flipped and said, if you think EVs are the future, then why are you owning a company which is selling petrol cars or diesel cars? Or why do things like HPCL, BPCL or Indraprasth Gas exist? Now, transition is happening, but doesn't mean it will happen tomorrow, or doesn't mean that entire business will go to zero. Again, people could ask, digital streaming is happening, then why do you own these satellite television companies? Now, streaming will take some market share and it will eventually grow, but doesn't mean the legacy business goes to zero immediately.
Question to Rukun on arbitrage scheme. Can high inflows in arbitrage scheme create any systematic risk in this category? How much return can investor expect in this category in the worst case scenario?
So, we can't predict future returns, or we can't guarantee what returns will come from the scheme. Historically, arbitrage returns have been similar to what liquid fund returns have been. What happens is, when a lot of capital comes into the arbitrage category or flows into arbitrage trades, the spreads come down, and that reduction of spreads ultimately leads to the capital going out as well. So the demand and supply for arbitrage capital keeps spreads somewhat similar to liquid over a, let's say, 6 months to a 12-month kind of a time frame. Over shorter time frames, it can definitely be much different. So that's how things have played historically. Going forward, we can't predict how it will play out.
Yeah, and on the question of systemic risk, it's largely driven by the clearing corporations and the exchanges. As long as they keep the margining system intact and they collect all the mark-to-market margins and they run it efficiently, I don't see why it should create so much of an issue. So the markets today are far well regulated, and the exchanges and clearing corporations are very, very strict in terms of implementing the upfront and mark-to-market margins and exposure limits. So I would not expect a systematic risk because of this.
Yeah. How do you interpret Uday Kotak's statement that the Goldilocks period of Indian banking system is over? Yeah.
The banking system goes through these cycles. You will have periods of extreme high stress in the balance sheet where some loans start going bad, and at the same time you'll have periods where the credit loss provisions are very, very low. So what Mr. Uday Kotak referred to, I think, would be referring to the extremely low loan loss provisions that we are seeing right now. Now, today, if we are at very, very low levels, the only way the provisions can go is higher. So as far as that goes, his statement is correct. Apart from loan losses, there are other factors which affect bank profitability. The other factor is the nature of the yield curve, where banks typically have short duration deposits, current account, saving account balances, which are low cost deposits for the banks. They are able to deploy that money at much higher yields. Today, the stress is in that area. So that is not definitely in the Goldilocks kind of period. In fact, liquidity wise, the sector has been stretched. So today, as compared to treasury bill yields, banks are having to pay far more for their certificates of deposits or for their 1 year bank FDs. So given that kind of a scenario, the spreads that they are earning are compressed. So while 2 years from now, 3 years from now, you could see a small uptick in the loan loss provisions, but you could see a small increase in the spreads as well. So we'll see how things go. But the cyclicality in loan loss provisions is a known fact for the banking sector, and they have been navigating through this over the years.
We'll take the final question. Can you please elaborate on the strategic rationale behind adding Narayana Hrudayalaya and Mahindra Mahindra to the portfolio?
Yeah, so in Mahindra Mahindra, the thing is that we've been tracking the EV space and the internal combustion engine space for a while, and the world over, in some countries at a slower pace, in some countries at a faster pace, that transition is happening. The product strategy, the market acceptance of Mahindra and Tata's has been good in this space in India in terms of the product roadmap and the launches that they have done. Tata Motors, the balance sheet has been a bit stretched, and again, in Tata Motors, bulk of their operations are abroad because of Jaguar Land Rover. So it's not a pure play Indian auto company in that sense. So given the recent product launches and the EV roadmap, we thought that it would be good to add another auto company to the portfolio rather than only allocating money incrementally to Maruti. So instead of just having Maruti, we have Maruti and Mahindra in our portfolio, so that we have some bit of diversification in that sector, and we can benefit from growth in either of the companies. Healthcare or hospitals in India has been a promising space as well as a risky space in that sense. So one is, it's a sensitive sector where one has to focus not only on the profitability but the patient outcomes as well. So you don't want a situation where there's accusation of price gouging, or where the middle income or poor customers feel shortchanged. So Narayana Hrudayalaya is a well-run company, and at least so far what we have seen is they have been able to manage the social obligation as well as the profit objective reasonably well, and they have been executing well in terms of the increasing the network also in India as well as overseas. So they have the Caribbean hospitals as well that they run. Again, given the increased emphasis on healthcare in India and the increased supply of doctors, given the increased number of medical seats and all, the ability to scale should not be so much of a problem. And we have had small exposure. We have taken a small position in this company, and we'll see how it goes. We'll monitor it and decide on the future course of action.
So thank you everyone for joining in on the call. Thank you, Prithvi, for moderating the session. I would like to inform everybody present on the call that on 11th of March, we will organize one more conference call for our debt schemes. So meanwhile, thank you so much for joining in. Thank you, everybody. Thank you, Rajesh sir and team. Thank you.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.